Hello and welcome to this week's podcast brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker providing trading services in Forex, stocks and commodities in multiple destinations. I'm Michael Hewson and joining me again is Pepperstone Senior Market Strategist Michael Brown. Good afternoon to you, mate. And how are you today? Or how are you this week? It's been a busy week.
Very good afternoon, mate. Yeah, it has. A bit of a sort of baptism of fire. I think everyone's been thrown in right at the deep end as the new year's got underway, certainly with what's been going on here in the UK, which I'm sure we both have plenty to say about.
Yeah, first full trading week of 2025 generally tends to be a time when markets are sort of feeling their way, trying to find out what the underlying trend is likely to be. And it's been a choppy start. I think we can certainly surmise that from what UK markets have been doing, German markets, European markets and US markets, and Asia markets actually finished the session actually lower on the back of some pretty broadly expected Chinese inflation numbers. But it's been, I think the talking points, I think we can agree, has been the sharp rises that we're seeing in bond yields, not only here in the UK, but also globally. But it's not just a global phenomenon, is it? Care to sort of expand on that opening?
Well, you should do your disclaimer first, and then I won't get in trouble for what I say.
Actually, that's a very good point. And, I'm so glad you reminded me of that.
And you printed it off especially as well.
I did as well. I then completely forgot about it, and now that's called old age, mate. Okay, so the information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers, or listeners of this content to seek their own advice. Spread bets and CFDs are complex instruments and come with a high risk of losing money rapidly due to leverage. 75.9% of retail investor accounts lose money when trading spread bets and CFDs with this provider. Okay, so thank you for that welcome reminder. I knew I can always rely on you to make sure that the housekeeping is kept in order, probably due to the fact that your compliance department will probably beat you with a big stick if you if you don't conform. So,
indeed.
Anyway, so we've talked about it. Choppy start to the year, impact of possible tariffs from a new Trump administration, weak stagflationary economic outlook. Obviously, the UK bond market is front and centre, but this rise in yields is not particularly unique to the UK bond market, is it?
No, it's not at all. I mean, you're absolutely right. It is a global phenomenon. This sell-off that we're seeing in government bonds, particularly at the long end of yield curves. I think 10-year yields in Japan are at their highest level since 2011. The 10-year bund is back above 2.5%. The UK is clearly underperforming, and there's some specific reasons for that, which we can discuss momentarily. But I think really there's a few things at play as participants get sort of fully back up and running for the new trading year. The first is obviously we are about a week and a half away now from President-elect Trump being inaugurated on the 20th of January. And it would seem that whereas sort of towards the beginning of December, when Scott Bessent was nominated as Treasury Secretary and the market was thinking actually maybe the deficit is going to be brought under control, it now looks that actually that may not be a focus, at least initially, of the incoming administration. And of course, this week we've also been buffeted left, right and centre by headlines in terms of tariffs, which it does appear, at least from the reporting that we're getting, that the proposals in terms of tariffs are going to be firstly universal against pretty much all of the US trading partners, and secondly quite sizable in terms of their nature. I mean, CNN had some reporting out on Wednesday saying that the Trump's team view there being nothing off the table. So of course, naturally, you've seen the market move inflation expectations higher, price a bit more of a hawkish policy path globally as well. And I think really perhaps the biggest thing is that there is this huge cloud of uncertainty over proceedings at the moment, because we're dealing with, sources, stories and rumour and all the rest of it. Until we get some clarity, I think perhaps one of the biggest factors is no one really wants to step in front of this move until we have a bit more certainty. And that in turn is fueling the sell-off even more.
Yeah, indeed. But, I think what we do need to, take into account here is that, Trump always, basically waves a big stick when it comes to what he's, when he sets out his stall. And we've been here before. We were here in 2016. And ultimately, the reality proves somewhat slightly falls short of the actual rhetoric. And I think there's a tendency here, to sort of try and front run and overshoot. Having said that, the reaction of UK markets, I think, has seen a significant, I wouldn't say outperformance, but people are saying this sell-off in the UK in the bond market is merely a symptom of what's happening globally. Now, I would push back against that and
I would disagree strongly with that.
It's not, because if UK yields were moving in line with US yields, UK 30-year yields wouldn't be at their highest levels since 1998. And UK 10-year yields wouldn't be back at levels last seen in 2008. There are other factors at play here. And the fact of the matter is, despite the fact that UK 30-year bonds are the cheapest they've been in 30 years, does that mean they're good value? Or could they have further to fall?
Well, my view is firmly that they could have further to fall. I think the biggest concern, or the biggest perhaps warning sign for me from the action that we've seen in the UK this week, is we have seen this really sizable sell-off at the long end of the curve. As you said, the 30-year yield trading, I think probably about 20 or 30 basis points higher over 2 or 3 days at one point this morning. Obviously, we have seen that move pair just slightly as we speak. But that move has come at a time when the pound has fallen by about 2% to its lowest level since November of 2023. And of course, normally you would say, all else being equal, as yields rise, the currency should rise in tandem with that. And for me, the fact that those two have disconnected, that's a real big red flag, saying that actually the market's completely lost confidence in the UK's ability to deal with the fiscal backdrop here.
Yeah, it seems strange, though, the timing of it, because, there's nothing new from what we've seen this year to what people were saying after the budget.
No, you're right. There isn't anything new. I think, certainly there's been no new government policies. There may be a little bit of a case of momentum behind it. Once this kind of global sell-off has started to gather some pace, actually it's dawned on people how perilous the situation is here in the UK. And actually, Capital Economics, they had a note out earlier in the week saying that the Chancellor's fiscal headroom, which was at about £10 billion, which in fiscal terms is absolutely nothing, by the way. £10 billion, it sounds like a lot of money, but in the grand scheme of things, in terms of trying to meet your fiscal rules by 10 billion, that is cutting it pretty close. Capital Economics were out with a note earlier in the week, and I think this was on Wednesday morning, saying that they estimate that headroom at the time to now be just £1 billion because of the move higher that we've seen in yields, and also the fact that the economy hasn't actually grown at all since all the way back in last August, and we get GDP data out next week. Now, since they published
that's monthly GDP, not quarterly GDP.
Yes,
I think we need to basically stipulate that.
Yes, that's very true. Now, of course, since they published that note, yields are another 10 basis points higher. So effectively, we're now dealing with a situation where there is no headroom whatsoever, and the government are very, very close to a breach of those fiscal rules. And as a result of that, you're looking at the next fiscal event, which is on the 26th of March, and saying that actually Rachel Reeves, the Chancellor, is going to have to come back with either further revenue-raising measures, i.e. tax hikes, or further significant spending cuts to government departments in order to try and balance the books and restore the headroom and some degree of credibility.
Yeah, I wrote something about this on my Substack earlier this week, and I've read an awful lot of notes in the FT or comments in the FT, the Telegraph, and various other business publications, saying that, as you said, that the government will have to come back with further tax rises, which beggars belief. We're in this mess right now because of the fact that the government imposed 40 billions worth of tax rises on businesses, the productive part of the UK economy, in an attempt to fill a fictitious 22 billion black hole in the public finances. Now, everyone knows, well, every self-respecting financial professional knows that that's a lie, because if there was a black hole, they wouldn't be spending billions of pounds on carbon capture and various other projects to basically further the renewable energy, transition. In addition to all the extra money that they're allocating towards the public sector. So for me, I think this speaks to an acceleration of the fact that markets have realised we're not going to get any growth this year. And if we do, it's going to be very weak, and inflation is likely to remain high.
Yeah, and I think that's the real problem for the UK, and I actually put this in one of my notes this morning, is that we are in this, I may have actually tweeted it out, we are in this kind of worst of all worlds scenario where you have a market that has clearly lost confidence in the Treasury and in the Chancellor, an economy that is stagnating and looks like it will continue to stagnate for quite some time to come. An inflation which remains elevated, and particularly when you look at underlying inflation, core and services figures, we're talking about inflation that's 1.5 to 2.5 times the BOE's 2% target. So actually, we're dealing with what is effectively stagflation here in the UK, and that means that the BOE is sat there going, well, the logical response, or the response that you would kind of say, what would solve the problem? Well, actually a dovish pivot from the BOE. That would take some of the selling pressure out of the gilt market. They can't pivot into a more dovish stance when you've got services inflation running at 5%. So again, all focus falls back on the Treasury and the Chancellor to go, actually, you need to restore some confidence here, and you need to do that pretty damn quickly, because the gilt market is firmly in the market's crosshairs at the moment, and it's not going to take particularly much more for us to get a continuation of this pretty brutal sell-off that's going on at the moment.
And sadly, the Bank of England is not helping, because it's still doing quantitative tightening and selling its bond portfolio, which is placing further downward pressure on prices and helping to push yields up. And ultimately, no one wants to buy those bonds because they have no confidence in the government meeting its fiscal rules without either raising taxes further or embarking on significant cuts to public spending.
Yeah, indeed. And of course, the other thing that has gone a little bit under the radar among all of this, and understandably so, given what's been going on, is that we're talking about a potential breach of the fiscal rules. We're all forgetting the fact that actually in October, Rachel Reeves changed the rules to give herself more headroom, and has still somehow ended up blasting through all of it. It's utterly ridiculous.
I think this comes down to confidence, unfortunately. And I think, if you look at the first 6 months of last year, business confidence was fairly high. It was fairly positive. Within days of coming in, the new CEO and CFO of UK PLC decided to do what the Rolls-Royce CEO did when he took over, and basically called the UK a burning platform. The problem is that, unlike Rolls-Royce, the markets took it very literally and torpedoed business confidence, torpedoed consumer confidence, and now we're basically reaping the whirlwind of that in the wake of, obviously, the budget that she embarked upon at the end of October. Anyway, I think we probably talked about this about as much as we can. But I think
we're going to depress ourselves if we talk about it any longer as well, aren't we?
Well, exactly. And you talked about the pound, and you may remember the conversation that we had at the end of last year about my forecast for the pound, and I said that further downside was likely, and here we are. And I think we could well be heading towards 120. In fact, I would suggest that we probably will head towards 120. Even if it's not on the back of a weaker pound, I think the dollar is likely to remain strong. And I think you could be losing your bet on the euro as well, because I don't think the outlook for Europe is much better.
No, I guess the one thing that Europe potentially doesn't have to deal with quite as much as the UK is the fiscal concerns, because you do have the knowledge that the ECB will come up with another acronym to solve the problem. I would say though that actually I agree with your sterling call. I don't see, personally speaking, any particular reason why I would want to hold any UK asset really at the moment, whether it be the pound, whether it be gilts, even equities. You just kind of look and go, well, firstly, there's nothing particularly attractive about the UK economy. Secondly, there's nothing particularly attractive about those assets. And thirdly, you compare them to what's on offer globally in the FX space. Why would you not want to just go and sit in the dollar with the US economy outperforming as much as it is, and Trump coming in and likely putting a load of tariffs on, which are dollar positive by default?
Well, then surely that would affect the big caps in the FTSE 100. So in essence, that would potentially be a positive for the FTSE 100 for the dollar owners like Shell, like BP, like the big multinationals in essence. And I sort of take issue to a certain extent with your depiction of some UK companies, because only this week we've seen some of the big retailers post some very, what I would argue, fairly decent Christmas numbers. We talked about this last week. Next, Marks and Spencer's, Tesco's, all three have reported some very solid numbers for Christmas trading. Not that you'd know it from some of the share price reaction, mind you. I mean, Marks and Spencer's is down 7.8% as I speak. It was down 10% at one point. But I think that was largely as a consequence of the fact that they kept their guidance unchanged and warned about a cautious economic outlook. And then you look at Tesco's, kept their guidance unchanged, and their profits, £2.39 billion of retail adjusted profit for the year, free cash flow between 1.4 billion and 1.8 billion pounds. That suggests to me that the business is in fairly decent health, and ultimately, they were one of the best performers last year. Retail, Marks and Spencer's, Next again, posted some fairly solid numbers, upgraded their profits again. But again, I think all of these three retailers did warn that they were going to have to make cost savings. Next, £67 million in additional costs. So they're going to be bringing in self-service tills. And again, we talked about this at the end of last year.
We did. You're absolutely right, and I think they are probably the two things that, obviously the market's being pressured more broadly, but they are probably the two things that do stand out to me. One is the fact that the guidance was, yes, Christmas was clearly strong, but there was no sort of acknowledgement that those strong trends are likely to continue, because the guidance was pretty much unchanged across the board. And also, as you say, all three of them flagging that costs are going to increase as we move through 2025 as well. So, I think, yes, clearly Christmas was very, very strong for the UK consumer. And by extension, you would expect a pretty decent retail sales number when we get that data next Friday morning. But actually, the bigger question is that strength going to continue? I would argue probably not, sadly.
And generally, stock markets do tend to do well, recession or not. So, I think for me to sort of be, holding the sword of Damocles over the stock market, sort of suggests that, I think that's probably a step too far. I think there are pockets of value. We've got some really good companies here in the UK, Rolls-Royce being one, looking to expand its Goodwood site. Obviously, that's Rolls-Royce Cars, which is owned by BMW. But again, that's a positive for the UK economy. So I think, you do have to look for positive stories, despite the fact that, we do appear to have, sort of a student union, government, if you like.
You're being a bit harsh on student unions there, Mr. Hewson, I think.
Maybe so, but I mean, you're talking about schoolboy errors when it comes to, speaking to the markets. And I think, for all this talk of Rachel Reeves being replaced as Chancellor or being used as a scapegoat by Keir Starmer, I'm struggling to see who'd take her place.
Well, actually, I'm glad you brought that up, because I was asked this question. Actually, I've been asked this question a few times over the last couple of days by a number of clients. And if you'd have asked me in October, November, is Rachel Reeves going to be replaced as Chancellor anytime soon, I'd have probably called you completely mad. But actually, I reckon there's probably a decent chance of it now, because if Labour do need to raise more revenue, they're going to have to breach manifesto commitments. There's realistically no significant revenue raising you can do. Well, they have, I agree.
We're not going to raise tax on working people. Hello, national insurance.
No, I completely agree. But if they were to, the definition of working people has already been stretched to the absolute limit anyway. If they were to sort of formally break, let's say they were to come out and say we're going to put income tax up by a penny on the pound, whatever it may be. I'm not saying that that's my base case, but your scenario that you alluded to is the obvious one. We need to raise more tax. We need to break the manifesto. Well, sadly, the Chancellor's a scapegoat. Out you go. So if the turmoil that we're seeing in markets does continue and this headroom does continue to get eaten away, then maybe her days are going to be numbered. And I think that the odds on her not seeing out the year are considerably shorter than they were 2 or 3 days ago. But you're right. Who the hell comes in as a replacement? Because I don't know whether you watched the urgent question in the Commons earlier that was answered by Chief Secretary to the Treasury, Darren Jones, who's effectively her number 2. And, well, he certainly didn't instill any confidence whatsoever. And
Guy doesn't even have a Bloomberg terminal. I mean, what's that all about?
He can't afford one, apparently.
Stick it on expenses. They stick everything else on it.
Yeah, so you got him, and then the number 3 in the Treasury, I think, is currently under investigation for some sort of corruption. So, where does that leave you?
Yeah, okay. Yeah. Well, again, it goes back to, the market perception that the country is being run by adults. And apparently these people were supposed to be the adults in the room.
Well, indeed.
Okay. Well, I mean, we are where we are. I mean, basically, we as professionals need to look beyond that and look for pockets of value. And for me, I think when you set all of this sort of stuff aside, it's going to be difficult for businesses. But I think businesses have shown that they can adapt. My biggest concern is that the biggest businesses will get bigger and the smaller businesses will increasingly struggle more and more.
Particularly as cost burdens increase as well, because they're not as easily able to absorb those as their larger peers.
So they won't take people on.
Exactly.
They may not get rid of people, but they won't take people on. And when people leave, they won't replace them. So you'll have what I would call is natural wastage when it comes to people leaving, which sort of brings me on to next week and the GDP numbers. This is going to be the GDP numbers for November. We've come off the back of 2 monthly contractions, September and October, minus 0.1. Third quarter GDP was revised down to, I think, from 0.1%, which I thought was optimistic, to 0%. So could we already be in recession, Michael?
Very good question. I think I would actually argue whether we're in a technical recession or not doesn't particularly matter. If you see 2 consecutive quarters of contraction, does that, what's it good for? It grabs a shed load of media headlines, but does it change? Does it change how you trade or how you view the markets? I would argue no, it doesn't.
But it translates into weaker consumer confidence because you've got the BBC and the media saying, we're in recession.
Yeah.
People are going to be reluctant to go out and spend money.
Yeah, that's very, very true. You will probably see a bounce in GDP that means we skirt recession narrowly. As we were just saying, it looks like the consumer has had a pretty strong festive period, and you would imagine that is enough for the economy to eke out some degree of growth in the fourth quarter, particularly when we're dealing with such a low comparison and a low base from the 3 months to September.
So December retail sales is the number to watch next week.
Yeah, absolutely. But by no means am I sat here going, oh, well, that means that all is fine and dandy and we can, pop the champagne and celebrate, because risks to growth are quite clearly still tilted firmly to the downside. But again, it just means you don't get those headlines of, the UK is in recession, et cetera, et cetera, et cetera.
So we've got CPI next week, inflation for December.
Yes.
We saw that edge higher in November. We saw the Bank of England in December vote to keep rates unchanged, but it was a 6-3 split. So
which was surprising.
Which was a little bit surprising because we had Alan Taylor and Dave Ramsden join Swati Dhingra in calling for a rate cut. So that would suggest to me we're probably going to see a rate cut in February when the Bank of England updates. I was going to say upgrades, downgrades.
I don't think there's going to be much upgrading going on, sadly, no.
Downgrades its economic fall. I mean, I'd like to think that they're going to be optimistic, but to my mind, short of the economy falling off a cliff, I can't see the number of rate cuts that they're looking to implement panning out by any stretch of the imagination. And it will make it very difficult for the Bank of England to cut rates against such an inflation backdrop, which you outlined earlier, which suggests that they might do something else, maybe stop selling off their bond portfolio to try and support gilt prices.
Yeah, potentially. I mean, they've always
or do QE.
Oh Christ! Well, on quantitative tightening, the BOE have always, to be fair to them, maintained that if there are financial stability concerns or if the market is becoming disorderly, then they will pause or slow or end that process. I don't think we're there yet. And actually, I was asked this earlier on, going back to that statement in the Commons, when Darren Jones said, moves in the market are orderly. If you were to stick with the definition of orderly, yes, they are. There is liquidity, that volumes are healthy. We're not seeing, anything that's particularly problematic from a market functioning perspective. That's not to say that the moves we're seeing are what you want to see. It's just to say that actually the market hasn't broken yet.
But it's showing signs of
creaking.
And I think the thing is, Michael, Bank of England's cut rates, right? 50 basis points so far. It's 2 rate cuts in, and bond yields are higher.
Yeah,
that doesn't happen in an orderly, properly functioning market.
But that is also something that we're seeing across the globe. The Fed have cut rates by 100 basis points, and you've had the 10-year move about 80 basis points higher since they delivered that first cut in September. So, that's not just a BOE problem. I do think that December CPI figure that we get next week is going to be really interesting. Not only for the implications in terms of the policy outlook, but also, if we are sat here in the middle of next week with the gilt market still as on edge as it is now, which you would imagine it would be, that's not going to, drastically change in the space of 4 or 5 days, particularly when the Chancellor's flying off to China. So I think that CPI number is coming at a time when the market is clearly very, very worried and very, very nervous about the situation here in the UK. And if inflation comes in hot and you see the market reprice a more hawkish outlook for the BOE, then that's a real issue in terms of the gilt market at that stage, because where is the bottom for the long end or the top in terms of yield, whichever way you want to look at it.
Having said that, the yield curve is starting to uninvert now, so that's a good thing, right?
Oh, that's great. 30-year yields are trading at 27-year highs, but at least the curve's steeper.
Yeah, at least the curve is basically going from, low to high as opposed to high to low, which, shouldn't happen. You shouldn't have short-term borrowing costs that are higher than long-term borrowing costs. No. So basically we are sort of heading in the right direction. What you want to see, though, is you want to see short-term borrowing costs coming down and long-term going up, and that's not happening. They're all going up.
Yeah, exactly. It's just the fact that the long end is selling off much more rapidly than we're seeing at the front end.
Okay. All right. So the key takeaway for next week, I think, is really UK CPI, UK GDP, UK retail sales. And I think broadly, we could see a semblance of good news next week with potentially positive reading on CPI, not CPI, on retail sales and GDP, with inflation remaining sticky. Okay, and we've also got US CPI next week, so of course that will then feed into a potentially stronger dollar narrative, which could also be potentially sterling negative.
Potentially, although I would actually, I was going to say I'm going to stick my neck out here, but actually I don't think I am. I would say that US CPI next week I'd argue it doesn't really matter. The market has firmly priced in the fact that the Fed are going to skip the January meeting and leave rates on hold. All of the comments that we've had early this year from Fed officials are very much in keeping with that view of they are going to continue cutting rates, but they're going to go slower this year, and they want to see more data before delivering any further cuts. And also thinking about the timing of the CPI number, it comes out next Wednesday afternoon, 5 days or 4.5 days before President Trump's inauguration, and also the day that Q4 earnings season kicks off as well. So I think actually in terms of all of those catalysts, you kind of go, markets are going to be focused on things other than the inflation numbers, barring a big deviation from consensus in either direction.
Or a December jobs report that maybe misses by a very wide margin.
Well, potentially. Although I think the one person in the world who wants the December non-farm payrolls number to miss more than anyone else is Chancellor Rachel Reeves, because it would probably do her a big favour in terms of what's going on with gilts.
Yeah, exactly. Yeah. And that's obviously due on Friday. So be interesting to see whether or not that comes in. The low expectations that the market is setting for it, which I think is 164,000.
Yeah, around that
jobs.
mark.
But even though weekly jobless claims are still very, very low.
Indeed. And actually, I think the initial claims were 201 in the last week of the year? Yeah
201. Okay, so we talked about US earnings season. Before we get to that, got a couple of more retail announcements next week. Ocado. Maybe they'll turn a profit. Maybe they won't. I don't know. We'll have to wait and see. We've also got Whitbread, owners of Premier Inn. See what type of quarter they've had. They're growing their German business, and that's starting to show signs of actually paying dividends for them. So it'll be interesting to see how they get on. Ocado's due out on the 14th of Jan, fourth quarter. Whitbread is due out on the 16th of Jan, third quarter 2025. Which brings me neatly on to US banks. And JP Morgan Chase, Goldman Sachs, Wells Fargo, and Citigroup all reporting, as you rightly said, on the 15th of January. So
Indeed. And
what are you looking for, Michael?
Well, I was going to say, and then they're followed very quickly after by Morgan Stanley and Bank of America on the 16th. So we get all the banks reporting in the space of about 24 hours, which is going to keep us very busy, isn't it?
It is. I mean, one of the things that struck me about JP Morgan and Goldman Sachs in particular was the fact that their share prices hit record highs in the aftermath of Trump winning the presidential vote in November. But what was particularly noteworthy on their third quarter numbers, and this is particularly with JP Morgan, was that revenues were up, profits were down on the previous year. And I looked at why in this, and they set aside higher reserve bills, which is interesting. Banks don't generally do that if they're particularly optimistic about the economic outlook. And they also raised provisions for credit losses. So I think this was largely due to the fact that was due to increases in its credit card loan book. So obviously, if you grow your loan book by X amount or X percentage,
your provision needs to grow by the same amount.
Grow by the same amount.
Yeah.
And that's why profits were lower. So Q4 profits are expected to come in around about $3.98 a share. But what was interesting was they raised their guidance for net interest income to $92.5 billion. I mean, that's a hell of a lot of money, isn't
it? It is. I mean, the numbers that JP Morgan are pulling in are just quite frankly staggering. The other thing that I would be paying some attention to, and I know you've actually flagged this in your week ahead, which where'd you publish that? Is that on your Substack?
It goes on my Substack.
There we go, on your Substack, which I've had a sneaky advanced preview, and I'd recommend that our listeners go and read that when we've finished. But the other thing that you mentioned, interestingly, is around financial and bank regulation under the Trump presidency. So it will be interesting to see if any of the CEOs have anything to say about that on the earnings calls. And the other development, of course, that's taken place on that front over the last week or so is that the Fed, the vice chair for supervision, Michael Barr, has actually resigned. He's going to be stepping down from that role as of the middle of February. So Trump will be coming in and able to appoint not only a Fed vice chair for supervision, but pretty much the head of all of the financial supervision authorities in the United States, whether it be the SEC, the CFTC, whoever. So it is going to be very, very interesting on that front, the degree to which the incoming administration does look to cut some of the red tape and also potentially lower some of the capital requirements on the banking sector, because Barr was a proponent of, and I don't want to go into the weeds of Basel III and all the rest of it here, but basically Michael Barr was a proponent of raising the capital provisions that banks need to keep by quite a significant margin. You would assume that his replacement would be wanting to perhaps scrap that entirely or raise it by a less significant degree, and in turn that could prove to be a bit of a fillip for the sector more broadly.
Yeah, I have my reservations about that. I mean, because I think if there's one thing that the Silicon Valley Bank thing taught us in 2023 was the fact that the reason the US banking sector was able to shrug that off was because of the much higher capital requirements that were levied on the big banks, and allowed banks like JP Morgan to help bail out those smaller players. And I think it's quite interesting that as we head up to the inauguration, the Russell 2000, which really outperformed in the aftermath of Trump's confirmation, has started to give back quite a few of those gains already.
Yeah, no, that is a very good point, and I think there's a few factors at play there, and I think the way that I think people are kind of looking at the run up to Trump's presidency is you've had the initial, I guess, euphoria, particularly when it comes to small caps of, Trump's in, we've got a red wave, the GOP are in control of everything for the next 2 years at the very least. And now I think we're moving to a phase where people are going, actually, I'm going to take some profits from that move. We want to get flat. We want to take some risk off the table as we move towards the early days of a Trump presidency. And then, if we get to a situation where actually a lot of the campaign promises are implemented, then maybe the market then moves on its next leg higher. But I think it's very much a case of protecting the gains that may have already been made rather than any sort of about face in terms of sentiment or anything like that.
Yeah, it's back where it was on the 4th of November. So it's basically given up all of those gains. So again, it'll be very interesting to see how that plays out.
Indeed.
Interesting to note, though, that it is holding above its 200-day moving average on the Russell 2000. And my squiggly lines of my crayons did predict that the pound would go lower.
Oh, here we go.
I would suggest, mate, that sometimes paying attention to technicals.
Did your squiggly lines predict that Gilts would throw a tantrum and Rachel Reeves would hide under a desk somewhere as well?
No, unfortunately, it can't predict that type of human behaviour. Sadly, it just works on the basis of price, and that's all I'm interested in. What is the market doing? What are the price? What are the supply and demand dynamics of a particular asset, and that's reflected in the price movements. And for me, it's fairly straightforward. And the cornerstone of my approach to risk management, and I know you're trying to stifle a yawn there.
No, I was coughing, actually. I muted my microphone because no one wants to hear that.
Yeah, I was just digging you out a little bit because I know you are sceptical on it, but mate, I've been doing this for 30 years, and for me, they're the most reliable indicator because they reflect everything that's out there that is known about a particular asset. It's in the price. And yeah, it doesn't work all the time. Of course it doesn't. But that's why you have stop losses. That's why you have take profits. That's why you have risk management rules. You need a system. And that particular system works for me more often than not. And when it doesn't, it keeps any losses relatively small. And I think that more than anything, if there's any lesson at all to be taken from all of these podcasts, you've got to have a plan.
Yeah, absolutely. If you don't have a plan, then you're sort of falling. Well, I was going to say falling at the first, or you're falling before the first hurdle. Yeah. You need a plan for no matter what you're doing, whether it be a short-term trade or a longer-term investment. There always needs to be some sort of clear, coherent plan and objective behind that.
And they're different plans because short-term plans are a completely different dynamic to long-term plans.
Very much so.
Anyway, on that note, I think we can probably wind this up. So I think the key takeaways for this week are obviously keep an eye on the pound, keep an eye on gilt yields? Is there any further upside? Can gilts get cheaper? Will we get a little bit of a respite next week?
The other thing, actually, sorry to interrupt your little speech there. The other thing that I would pay very close attention to is the Sunday papers. And I know that sounds a little bit odd, but if we are, if there is any sort of desire from within the Treasury to try and do something to soothe markets, they will probably drip feed some sources, stories, or various rumours into the Times or the Sunday Times or the Sunday Telegraph or the Sunday Mail in order to try and have the aim of sort of soothing market concerns upon the open when things get back up and running on Monday morning. So do just bear in mind that we could see some stories over the weekend around revised government plans potentially.
That's a very good point. Because sometimes these sorts of stories can prompt a little bit of a gap or a gapping formation in pricing when the market reopens on a Monday. So it's certainly wise to be cognizant of those risks as well.
Indeed.
Okay, and so basically UK CPI, UK GDP, UK retail sales, and further earnings from the retail sector, and US bank earnings. So I think on that note, I think we can probably wind up the podcast for this week. And obviously we will revisit some of the topics that we talked about this week with respect to the UK data next week, and obviously assess any further movements, not only in gilt yields, but also in the value of the pound. So that's it for this week. Hope you all have a great weekend, and we'll speak to you same time, same place next week.
Indeed. Goodbye for now.
Cheers, Michael.
Cheers, mate.